Okay, what we're going to be talking about is business structure, and I put it here because if any of you have taken business law, have any of you taken business law classes? Okay, one or two. This one is very quick to the point, just a way for you guys to understand and appreciate something that isn't necessarily contract law, but it should serve as the basis of some of the issues that we might cover later on. So there are a couple different types of structures for a business. The first one we're going to cover is sole proprietorship. Sole proprietorship is a single owner of a company. And that has some wonderful things. You're the boss. But the problem with that is it's hard to find money. And you have what's called sole liability, which means if someone gets injured, if someone sues you for whatever reason, you're solely liable. It doesn't mean that you can't have insurance that covers you, but you can't point to another organization or entity and say, they'll pay. You have to pay yourself. So if you get into a car accident, you might have your insurance cover it, but if your insurance doesn't cover everything, let's say it's a $1 million verdict, and your policy only covers $500,000, you're personally liable for that extra $500,000, and they could take your home or whatever, garnish your wages, whatever, to get payment for that. That's one of the biggest problems with sole proprietorship. One of the biggest benefits is very little paperwork. You file taxes underneath your own name normally. You don't have to file massive filings with the government or anything like that. Very easy to set up, things like that. Just do something in the paper, also known as kind of thing, which is you put your name in the paper saying, I am doing business as DBA, also known as, and you publish that in the paper, then you start doing business under that name. That's okay. For a lot of companies, that's how they start off. The next level is called a partnership. Partnership, 2 or more partners. It can be 2 or more businesses, 2 or more individuals. There is something called a general and a limited partner. A general partner is one who does the management of the partnership. A limited only gives money. So if you start a partnership to create your own sporting good company, and if you just have someone that says, I just want to give you some money, and that's it. I don't want to be involved in day-to-day operation, that would be a limited partner, and their investment and potential loss is only what money they gave in, and that's it. A general partner can still be liable. In a standard partnership, though, the partnership, everyone in the partnership is equally liable for anything that happens. So if there's a major disaster for the company, let's say you have a truck and it causes someone to die, and this is that $1 million verdict, and you only have $500,000 worth of insurance, they could get that $500,000 if you have 4 partners, each one, they're going to try getting the money from all of them. And so if one person has $1 million in the bank and the other have nothing, you can still collect that $1 million, that remaining amount, $500,000, from the one who has all the money in the bank. Even though the others, you say, it should be equal, no. Wherever you find the money. So you're going to be liable for what your other partners do. A lot of people don't want that. Because you might say, I trust them as a partner, but that's about it. So you got to be careful with partnerships. It ends with the death of any of the partners. So if all 4 of you are in a partnership, and one of you, God forbid, dies, and you want to continue the partnership, you have to reform the partnership with 3 partners unless you bring in somebody else, and then that would be a new person in that partnership as well. So it dies the death of the party. You have this liability that still exists. Paperwork is still pretty easy. It's not that difficult. The next level is called corporation. Corporation, there's different ones, C corporation or S corporation. Corporation, the biggest benefit, besides being able to get more money, because you can go to investors and give them part of the business, and it's easier to raise the money if you're a corporation, is limited liability. That if they sue, let's say, Gil Fried's Badminton Emporium, and all your badminton supplies you ever want at my Badminton Emporium, and I incorporate it, so INC at the end, period. and I have insurance, and you get impaled with a shuttlecock in the eye, and you sue me for $1 million, and I have $100 million in the bank, but my company only has $50,000 in the bank. All you can get is that $50,000. It protects my personal assets. And that's why a lot of people formed corporations, is that they're not a person, but we give them certain rights similar to a person. So that's a good thing, right? You protect yourself. The problem with that is it's very expensive. You have a lot of filings with the government. You have to do annual filings. You have to do annual audited financial statements. There could be a lot of headache involved with that. The biggest problem is double taxation. So if I have my guilt-free badminton emporium, if I make $1 million, well, I'm going to be paying, let's say, 25% taxes to the government. Okay, so now I have $750,000. Let's say that's my profit. I take that home. When I take that home, I have to pay personal taxes. So now I'm getting taxed, let's say, at the 30% rate for that $750,000. So in total, I've been taxed almost 50%. I'm losing a lot of money that way. So that is one of the concerns associated with incorporation. And there's different types of corporations. There's public corporations, private corporations, limited corporations, Chapter S corporations, things like that. There's different types. But the primary benefit is limited liability. Primary harm is the double taxation and the expense of running it. The next level is called an LLC. There's also LLP. LLC is limited liability corporation. LLP is limited liability partnership. They started probably about 20 or so years ago. And what they have is the benefit of the sole proprietorship plus the benefit of corporation, plus the benefit of partnership. It's the best of all these worlds. So you have limited liability like a corporation. You can have major corporations part of an LLC, and almost every single professional team now in America is owned by an LLC, except for the Green Bay Packers. Because you can house it within an LLC. You might have another company that manages the facility under an LLC, a concessionaire that's an LLC. Everyone's doing LLC because one of the best benefits of it is called pass-through taxation, which means I have my own company called Gilfried and Associates. You know, it doesn't sell badminton gear. It's a consulting company. And that's my company. And it's an LLC formed in Delaware. And I formed it in Delaware because Delaware has more beneficial rules and laws for businesses. So if there's any dispute, someone's going to have to take me to court in Delaware. I pay taxes. The money comes in. I declare on my 1040 like all my other income from teaching. It makes it easy. Very limited bookwork. I formed the LLC. I pay a yearly fee in Delaware to house it. I pay a fee for an agent for service of process in Delaware. I keep my yearly books. I take my family out to dinner, and we have a yearly annual meeting. Hopefully it's a good meal, because I get to write off taxes. But we discuss the business during the meal, talk about what's going on, what are our plans for the year, and stuff like that. And it's very easy. I don't have to have any audited financial statements or anything else. Very smooth sailing. Now, what happens if someone were to come and sue me? And let's say someone says, look at, you know what, you gave us a risk management audit and it was completely wrong. You're blind as a bat. You didn't see that there were bricks in the middle of the base path and someone fell over and hurt themselves and got injured, and you didn't spot that. What I tell them is, you know what, you're right. If you want, you can sue me, or if you want, you know what, if you sue me, you can't sue me. You're actually suing Gilfried and Associates. Here's the keys to Gilfried and Associates. Take it. I'm done with it. And I tried keeping a couple $100 in the checking account. That's about it. And I can just get rid of the company. Just, bam, it's done. And then 2 minutes later, I call up someone in Delaware and say, I want to say Gilfried and Associates 2. or Gilfried and Daughters, Inc., LLC, or whatever, I wanna call it, kind of thing. And I can start it up the very next minute and do the exact same thing. It's changed the whole nature of how business is done. So LLCs have become the more popular approach to incorporate because it provides you that incorporation type of benefit of limited liability, but also provides you with ease of access and no double taxation, reduced cost of operation, stuff like that. So that's why you see a lot more LLCs out there in this day and age. LLPs, the partnership, sometimes you see it for doctors and lawyers. That's who often uses the LLPs. And the last area is nonprofit charitable organizations. That's where you might see an organization like the American Red Cross. The NFL is actually considered a nonprofit organization. And there's a lot of senators and congressmen who are trying to remove that protection that they have, because they say, look, it makes a lot of money. It should be considered a for-profit entity, not a nonprofit. A nonprofit entity should not be, they can make as much money as possible, that's not a problem. But the money that they make has to be reinvested for that nonprofit activity. So if you're making money as an NFL and not reinvesting that back in something that benefits the community or something else like that, you could lose your nonprofit status. And also, if you're engaged in activities where you're more like a business than a nonprofit, you might get what's called unrelated business income tax, which is taxed at about 28%, saying, look, you're actually no longer a nonprofit, you're doing this as a for-profit kind of activity, and as such, we're going to tax you on that activity. So a university like Ohio State got nailed with that, with their advertisements on their scoreboard, because they got close to $1 million a year for those advertisements. Back in the late 80s, the IRS jumped on them and the Mobile Cotton Bowl. So that really doesn't benefit education. In your educational institution, you're trying to do marketing, and that's not good. So what the IRS has done is they basically come down and said, look, you know what? We're going to open this to public debate to determine how should we decide what is unrelated business income. Because it's not just sports, it's museums, it's art places, it's performing arts, orchestras, things like that. All of them are impacted by this. And what basically the IRS came down and said, look, if you do too much, we're going to tax you. But we're not going to tell you what too much is because we don't know. So when we see it, we'll come over and we'll tell you you're in trouble. That doesn't give too much guidance for anyone. So that makes it a little more difficult. All right, so